All right, disclaimer, disclosure, whatever you call it. Objects in the mirror are closer than they appear. Really, Greg, can we please automate this? There must be a way to have a computer just read this. All right. Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades or securities in orders to discuss and track and monitor virtual trading accounts. Virtual account prices and returns may differ from other trading results. Commission costs are excluded. Neither PhilStarCorp.com, PSW, nor affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and services standardized options. PSW provides education and training services and meant to teach you risks and potential rewards of trading options. We are not, if a risk tells you what to trade, we are not implying guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary by access in this webinar. You agree to wholly about harmless from any losses you may incur as a result of the information discussed in the media identified above by access to the webinar. You agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Amazing. All right, it never changes, but I read it anyway. So where are we? Let me see. Any questions before we get started? Okie dokie. SG says, thoughts on RB short after the big round today? No. You don't short just because it ran up. You short because something gives you a reason to short it. You know, what happened? The dollar's been flat, so these things are going up on their own. Oil popped to 40.80. We had a very big drawdown in gasoline. That's what happened. It was like 3 million barrels, something like that. Anybody paying attention? 3.3. Boy, am I good. All right, so look at that. 3.3 million barrel draw on gasoline. 2 million. That's 3 million above consensus, blowing last week away. This drawdown in gasoline saved the whole report because we would have been the net. Here's the thing. You got to go by the net of the trade. So here they go -1.4, -2, and -5. So that's 7. So -2.1 was expected. And instead, you have 3.3 minus 1.4 is 1.9, and then minus another 1. So you end up with like a 0.8. So an $800,000 barrel net build versus. Is that right? Yeah, it is. Okay, so 800,000 barrel net build versus net draw. Wait, I'm sorry. 800,000 barrel net draw versus a 2 million barrel net draw, basically, that was expected. But still, a draw is a draw, because look at what your last week numbers were. Last week you had a build, and the build is 2 million minus 8. So you go from a 1.2 million barrel build last week to an 800,000 barrel draw this week. That's exciting for the bulls. That's as good as it gets, and it's led by, of course, gasoline. So, we can dig into the report. Oh, it is 1 o'clock, so let's take a look at the report. I mean, most likely there'll be some shenanigans. There usually is, but Petro. Come on, Petro. Oh, this one doesn't have my settings. That's why, because Jackie's signing. Petroleum. She uses this computer for her chat. Okay, so looking at the chart, I bet we'll see a big export number. Let's see. No, not so much. Okay. Can we bigger this? Oh, yeah, wait, if I do this. Okay, that's big. All right. This is the right one. Week ending July 29th, right? Okay. So what do we look for? What's the net? Okay. That's funny. So net, we have a build of 2.1 million barrels is a net build. So as usual, other oils, notice that, that's the big hidden category. Other oils went up 2.9 million barrels. So it wiped out the draw and gave us it wiped out the draw that they report on, and it gave us a net build. So it's really still not as good as it seems. They're still dumping a lot into other oils. But you can't deny that gasoline was used, okay? There was a draw in gasoline. Let's see if their inputs were normal. So, no big change in oil levels here. Refineries utilized at about the same pace. Gasoline production was steady. All right, steady from last week anyway, okay? It doesn't really prove anything. It's much more than last year. Exports, petroleum products will be gasoline, right? Exports were steady. All right, so basically, yeah, there was an upswing in demand for gasoline this week, apparently. See, the gasoline supply was the same. Distillate fuel, same. All others was where you see this huge difference. And that's it. Okay, so basically, the overall draw on oil is bogus, so I wouldn't really consider it a good time to go long on oil. But for whatever reason, there was certainly a temporary surge in demand for gasoline. And obviously, you know, you're talking 3 million. Look at the amount supplied. 10 million a day. So out of 70 million, 3 million build is a 5% move in gasoline. So for whatever reason this week there was a 5% move. Now, maybe last week not that many people filled up their tank, or maybe it's because the price dropped. Okay, consider that. In the last week, what happened? I know I filled up my tank. I was psyched to fill up my tank for $1.75 in New Jersey. I play the market with my car because I basically I run the damn thing all the way to empty if I think prices are going down. My kids don't like it. They get kind of, for some reason my kids get very nervous when I let the gas tank run down. But okay, so you see what happened? This week ended July 29th. What happened the week of July 29th? From July 22nd until July 29th, gas got cheaper and cheaper and cheaper and bottomed out on the 29th. So here, it's not that odd to imagine that a lot of people went out and filled up their tanks. That's what people do when gas is cheap, right? When you see good prices on gas, you go, oh, I'll buy some gas. So the low price, to some extent, causes the demand. There is and it's not. Here's the thing, the demand isn't elastic in that a low amount of gas makes you drive more. You don't consciously say, oh, look, gas is $1.85, so I'm going to drive an extra 100 miles this week. That's silly. People don't really do that. You might decide to take a vacation or something. And as we know, also we know that because we saw the numbers for the airlines. The airline traffic is down. That means more people are driving their cars so they're on vacation. And I'll tell you, I mean, I'm taking the kids to Florida. And it was like, you know, not terrible, but like $300 a ticket. So, you know, you used to get them for $150 a ticket. So when I'm looking at it, I was even looking at the thing saying, geez, for $1,200 for 4 tickets. I said, how much is the stupid train? At a certain point, you got to say, geez, I don't know if I feel like an idiot paying $1,200 to go to Florida. It's a 1,000-mile trip for me. So I'm not really psyched to drive 1,000 miles. I mean, 20 hours of driving is kind of a bitch. But, you know, people on more reasonable trips, like if it was Boston, there's no way I would fly to Boston. I wouldn't fly to even Chicago. I might drive. You know, I mean, it's a 17-hour drive. I know that. Not 17 hours. I'm 10-hour drive. You know, so something local, D.C. or something like that, I'm not going to fly to those places with the kids. I'd fly by myself, but I wouldn't fly back to pay for 4 tickets to get there. You know, not if I have any other reasonable way to go. So I think a lot of people make that decision and probably decide to drive rather than fly. So yeah, there's an uptick in demand of some type. But that's why you got to look at the net builds, because maybe on one side you've got more demand for gasoline, on the other side there's less demand for jet fuel. So I was going to say, oh yeah. So basically, so price sensitivity. from week to week, it doesn't prove demand. It may just prove that a lot of people saw gas prices fall below $2 again and said, oh, wow, I'll fill up my tank while it's below $2, because it doesn't usually last. And in fact, here we are reinforcing it because it didn't last. So until you see a trend that lasts more than a week, you can't make a decision, because literally the week before, it was 10% higher. Okay, so when you say 10% in a week, you say that's worth filling up for and topping off the tanks. So we'll see. All right, but I wouldn't call it any proof that gasoline is heading back up or anything like that. Lots of CL contracts today. Is it possible for them to get it up? I don't know who them are, so I couldn't make a comment on that. But no, between now and December, there's going to be a very, very tough time because of all the open contracts and that are fake. 99% of those contracts are fake. Because of all those open contracts on the NYMEX, they've got to get rid of them or roll them or do something with them. Puts a lot of downward pressure on oil, and I think especially not this month, but next month. This is the September contract, right? For August. Wait, what is it? Yeah, it's September we're trading now. So for September delivery, that's the contract we're trading right now. When you get into the October, November, December of the contract of next month, December becomes one of the three front months. The three current months are your front months, basically. When December becomes the front month, it is packed with contracts. That makes it very difficult to roll into because you're just jamming it up with contracts, like way too many. And that means that at some point they're going to have to capitulate on these contracts, probably before the end of the year. So it'll probably be a nice big downswing at some point. Meanwhile, though, it's early in the cycle. The cycle ends on the 22nd this month. It's early in the cycle. They've got 2 full weeks. They can fake as many contracts as they want. So any excuse, even a mediocre inventory report, they're going to push it up. But still, what you want to do is you want to watch what the limit is. How far can they push it up is what I'm more interested in. And, really, with a 3 million barrel draw in oil, all they can do is get $1 out of it. That's sad. That's really bad, okay? That just indicates some serious weakness overall. Total commercial rate. Thoughts on, you did the math, that was nice. I didn't do that one. Thoughts on TF and why? Is it because the Russell is an insane index, and that's why I love playing it, though. That's why I called it this morning. I said I like the Russell the best because, first of all, 1200 was an excellent place to set a stop. And where are we? Okay, so we know 1200 is fantastic support and resistance on the way up. So once it gets over 1200, as it did at 10 o'clock, I made the call earlier. I forget what time. What did I say about it? Control, find, TS. Oh, yeah. Didn't actually write yet. So I said this earlier from yesterday's post. In the pre-market, those of you who aren't in here, with 10:04, that was pretty good timing actually. We set that up. I'll show you how these trades. It's kind of important to see what we do. So down here, sometime early. 2:00. Nope, not Japan. All right. So here we were yesterday morning. Russell testing 1200 must hold, and 18.2 on the Dow. And at the time, I said I wish I kept the shorts. Then I said 2100 is the must hold line. If TS fails, we may get that 50-point drop, but it didn't actually fail. It failed a little bit, but not much. Okay. But then yesterday, this is now. Well, obviously 11:30 for what I said. 11. So basically 11. Oh, it's the same comment. So at the end of the same comment, I said, now that Europe is closed, we'll see if they can pump us back up. TF long at 1200 with tight stops below is a fun way to play for a bounce. And it's the same levels. They don't change. I did adjust it down. But basically, the levels don't change unless there's a little adjustment or something like that. But we watch the same levels all the time. It's not really complicated to trade this stuff. And then this morning we talked about this. 1200 was, in the pre-market, 1200 was gone. And that caused me to then, in the morning, I reevaluated it. And I said, to be clear, we're watching 1800, 2150, 4700, and 1200, and 16, we're watching for the cross. TF bullish at 1200 is my favorite, and Nikkei 1600 might benefit from the rumor during the day. So, that was at 1004, which is basically right here. So we had a little spike, or wherever it was down here. I guess this was a spike down. Anyway, down around here anyway. So it crossed up, came down again. So you had plenty of time to get in the trade. Okay, could have been in and out, in fact, if you were fast enough. But the point is, you see how it's a lovely line. It's a great line to play off of. You just go in there, you keep a tight stop below. And I don't mean a tight stop like these are 5-minute charts. So I don't mean a spike in a 5-minute line is going to stop you out. You have to have a little more conviction than that. But you know, basically, here's 1999. Here's 1199. It's way down here. So it didn't even lose a point. Okay, and one point is $100 on the Russell on a contract. So it probably lost about $50. I mean, you have to deal with that. You can't have a stop so tight that anything below the line. But we mean a stop. You know, you have to have a realistic risk and reward. You have to say, oh, I think I'm going to make at least $250. I should get at least to 12,120,250. That's $250. So I'm going to risk $50, $100 to make $250. That's a reasonable risk-reward ratio, because you can be wrong 5 times and right once, and you win. And in fact, had you done that, what would have happened is you could have gotten in, gotten out with 250, gotten back in, then made another 250, then come in here. Well, I mean, maybe you wouldn't have gotten back in, but you never know. But either way, it didn't stop us back out, and then it went all the way up here flying, and up here is a $1,000 gain already. That's what you do. You want to find the whole game is to wait until you're at a nice support line. And this morning we had a really unique opportunity because everybody was at a good support line. 18.2 on the Dow, 21.50. These are all strong lines. 4,700, 1,200, and 16,000 on the Nikkei. I mean, that's freaking incredible. And look at the Nikkei. You know, I said that, and that's why I said at 10. I said any little rumor. I said that at 10:04. Any little rumor, in fact, right here. So it didn't take long for me to be, by the way, I'm sorry. This could be us, though. When you see, in other words, Nikkei, all of a sudden, after I said the Nikkei, at 10:05, everybody starts buying the Nikkei. That could be just us causing it. You have to be careful about that, too, okay? If something goes flying up right when we say it, it may not be because I'm brilliant at my timing. It may be because so many people are playing this trade from our group that we're causing it to go up. So be very skeptical of these sudden rallies that you get caught up in. But same thing with the Nikkei. See, 16,000 is a lovely line. It was playing. I mean, it's same as Dow. It's $5 a point, so $250. Here's 250. Here's 250. Here's 250. Well, not quite 250. Here's 500. It's the same line over and over again you get to play. All right, these are a 5-minute chart. I mean, this is in one day. You don't have to get a $1,000 win. You can get a series of $250 wins. Don't wait to get the great big winner. Just take the money, reset. If this one gets away from you, go look to find who hasn't gone away from you yet. Then you go to the bigger picture, look at all your indexes, maybe. There it goes. And if somebody got away from you, you say, well, who's lagging? All right, and in this case, the NASDAQ is a little bit lagging. You can see it's just not as up as everybody else. So, in fact, it's a numerical thing here, 0.6. So if I'm going to play, I'll look for an opportunity maybe to go long on the NASDAQ if everybody else is popping their lines. So if everyone else is up, I want to see who's down. Now, the Nikkei's not up, so it still can go higher, but maybe that's because of the dollar. So then you got to go look at the dollar and see what's happening. And the yen is kind of flat, and the dollar is kind of flat. So the Nikkei has nothing to do with the dollar or the yen. So it's just trailing, which means it's a good play, which means it's still a good play, but not a good line. If you're going to do these plays, you can't just show up whenever you feel like it. You need to be watching the market and waiting. The worst thing you can do in the futures is be a lunchtime trader. In other words, don't be the guy who's at the office and then it's like 12 o'clock and you go, oh boy, I get to spend an hour trading. I have a half hour to sit down and trade. And then you sit there and then you're forcing a trade at a completely random time for no particularly good reason at completely random levels. That's a big mistake. If you want to trade the futures, well, you can do that. So the thing is, if you're going to do that, you then 9 out of 10 times shouldn't trade. You should just look at it and say, oh, not a good day today. You can do that. What you really want to do in the futures, though, is wait for opportunities when there are good levels being set, and then you trade. But you have to let the levels show you when it's a good time. You can't force it, and you can't make up levels just because you missed the other one. Not how it works. All right, so we go 2150 is a great line, right? Okay, so now let's pull back to the hourly chart. And what did we do? We fell from, well, here we fell from 2175, so that's not even usable. Actually, none of this is usable, is it? Okay, I'm sorry, so I guess we will have to use that. But as you can see here, we go from 2000 to 21, whatever the hell. 2175. And so if we went up 2,000, 2175, that's 175 points. So 20% pullback of 175 is like 42, right? And that, am I right? Yeah, 42. No, I'm wrong. 175 times 0.2, 35, sorry. All right, so 35. So 2175, obviously, minus 35 is 2140. All right, so 2140 would be a weak retracement. And we're up, look at that. Isn't that funny? Okay, do you guys understand what I was doing there? I went back to the bigger picture. Oh, come on. And take the consolidation here of the bigger picture on the daily. We definitely held the 2000 line. You know 2000 is significant anyway. So we go to the 2000 line. We go up to 2100, which is our must-hold line. But this rally was pretty much consistent. There was no significant pullback here. So if we have a 175-point run, then the 5% rule says that the retrace would be 20% of that run. So 175 points. Mr. Calculator, where do you go? All right, so all I'm doing is taking 175 points of the run times 0.2 is 35, and I subtract the 35. I'll clear it, it's easier. And then I take the 2175, well, obviously, minus 35 is 2140. So the 5% rule tells us that if we top out here, we'll pull back to 2140 as a weak retracement. And when you go to the hourly, lo and behold, where do we come back to? 2140. And when you get if you get a strong bounce off the weak retracement, that indicates that you're just doing a bullish consolidation. So now I want to know what a strong bounce off the weak retracement is. So I'm going to look now and say, hey. Okay, so then now we're going to see 21. Now we know our numbers. So it's 2145 to 2140 is 35 points. 20% of that is 7 points. So 2147 is a weak bounce, and 7 more, 2154, is a strong bounce. So that's where we are right now, a strong bounce line. And by the way, 1 point over, considering the indexes prefer to be at significant numbers, you don't say, oh, it's 1 point over there for blah, blah. It's not like that, okay? It has to, end the day there for one thing. You can't just pop over it for a little bit. But basically, that's where we are now. So now we know 2154 is a strong bounce off the short-term reset, which is part of a larger retrace off of the bull run. So if we're popping up now from here, that's going to be impressive because then you say, well, you know what? this whole thing looks like all it's doing is pausing the rally flags. Now we want to confirm that by looking at the other indexes, but that's the gist of it. So I hope that was clear, because that's basically the way you use the 5% rule in a nutshell. What TF there is that? Guessing gas stations were excited to fill up also. Oh, good point, Craig. Right. So that's another thing. Gasoline stations also gamble. And for them, they're buying, I don't know what those trucks hold, but they must hold a lot. That's interesting. What do you call those things? How much gasoline does a fuel? Oh, a tanker truck hold. Very good. See? Google is the best. 9,000 gallons. Okay, so they're buying 9,000 gallons at a time in that, which is, it's not that much actually, only $18,000. Interesting. Well, that's one truck though. I don't know how many tanks they got. It's interesting. I imagine the gas stations themselves must have probably one tanker truck for each type. So 9,000, I mean, let me see, 20 per car, 180 cars. They don't have trucks every day, so yeah, I gotta believe that they hold a lot more than that in the ground in the gas station. 9,000 gallons, give or take. Capacity is controlled by 80,000 gross rate limit for cars. Okay, good. All right, that's what we want to see. All right, so why do we want to know that? I don't remember now. Oh yeah, because he's gambling, right? So look, it's not much, but even 10 cents is $1,000, right? I mean, 10 cents for on 9,000 gallons for the gasoline guy, 10 cents plus or minus is $1,000 profit for him. So yeah, they're going to gamble, and you're right. They're going to pick up the phone right away when they hit a number that they know their customers. They know their customers. They know under $2, their customers are going to be like happy no matter whatever the price is. So probably when it gets under $2, and the guy right away is going to pick up the phone and go, "Hey, give me as much as you can." And yeah, they may make an early call. It does. See, the thing about the gas station it doesn't really hurt them to be wrong on a call because they are going to sell their gas, unless it's a really huge difference, which it hardly ever is. They are going to sell out their gas in a day or so. Maybe 2 days, 3 days, 30,000 in the ground. Thanks, Dan. So yeah, like I said, so they got 30,000 in the ground. They're going to order one tanker at least, right? If the price is good. That tanker is 180 cars, right? At 20 gallons a car. Probably not, obviously less than that. But so 200, 250 fill-ups, whatever. That would be. They figure a 10-hour day, 25 cars an hour. That's probably reasonable. So really, a tanker truck is 1 day. So they'll do what they can to order a little more. And like I said, there's no real pain to them in being wrong because they're going to sell it by the end of the day. It just may take them an extra 5 hours. So they're never going to lose money selling the gas. They price the gas based on what they buy it for. So they may be 5 cents more expensive than the guy down the road, but they're not going to be 20 or 30 cents off, in their guesses when they do it. But for those guys, making 5 cents is $450, right? It's a nice dinner out with the family or something like that. So yeah, they gamble too. So that's a very good point by Craig. What's your thought about Amazon after earning result last 2 days shares? Well, I thought they were too high in the first place, and I think they're too high now. And they don't earn enough money to make me change my mind. Google too. I called for short of Google at 800, and that's right here. Okay, so I'm comfortable with that one too. I think Google's out of control, and the only reason that all these guys are up is because it really is only because there's nothing else to put money into. All right, but the real money, and Amazon 750 is also my top call. The real money. But we chickened out of our play, which I'm not upset that we took before Amazon. I think did we talk about this last week? Before Amazon earnings, we decided that we were up $3,000 in our negative play on Amazon, and because we were up 3,000 and because we could have lost 20,000 if it went the other way on us, I felt better about being, just taking off the table. So you don't risk a $3,000 gain, unless you're really sure. And what happened to Amazon is our premise broke down because as everybody else reported, here's the thing. We had a premise that Amazon would not do as well this quarter. I thought they wouldn't do as well because I figured their competition in the cloud space was heating up, and it would hurt them as far as dropping those profits to the bottom line. And those profits are all of their profits. They don't make money on anything else. They don't. They lose money. Every time they send you a package, they're losing money. Their whole operation is subsidized now by the cloud business. But everybody who does cloud stuff reported a fantastic quarter before the Amazon earnings. So my premise fell apart. And because my premise fell apart, I didn't stupidly stick with the trade. I almost did. But what changed it was they put me on the fence about the value. Okay, I wasn't sure. And by the way, the earnings exactly reflect what happened to me. I wasn't sure. I thought there was a possibility that they would beat. I still thought they were overvalued. And I said that when I took them off. I said it's going to kill me if they go down, but also it would kill me if they go up now because I feel like an idiot losing the $3,000. Had we not been up, had we been down, I would have stuck with the trade. Because I firmly believe that over time, they'll go down. So anyway, my cloud premise fell apart as their competitors reported that just the whole space of cloud, everybody's moving everything to the cloud. So the whole space is growing so fast it doesn't matter what Amazon does. It's just, they're all just building their businesses. So, still, the bottom line, though, is Amazon. This is it. There's no other positive for them. They're ridiculously priced, okay? They don't make, do they make no, they don't make $100 a share. That would be the same. I don't think they make $7 a share. Let's go to the tape. Analysts, let's see what the projection is like. Okay, this year, $5-6 a share. Next year, again, where does this come from? These people pull stuff out of their asses. See, this is the thing. Well, we made 125 last year, and now we're going to make 573. Therefore, we'll make 10 next year. That's not how it works. Really is not, okay? I'm not sure how they're going to get there. But even at $10 a share, the PE is 70. That's a big PE. Okay? If you go to Apple, and I know people get sick of me talking about this, but I'm sorry. But Apple, where are we? Okay, Apple makes $10 a share now. Yeah, okay. Apple makes, here's $9 a share. And for whatever reason they have it down. This year, $8 a share. Apple makes $8 a share. But their share is not $700. That's now. That's not next year. That's now. Amazon is hoping to make this much money in a year. Apple's making it now for 1/7 the price. And by the way, 20% of Amazon's total sales are Apple products. So go to the source is what I'm saying. I would never play that. They're a tough stock to short. They just go up and up and up and up. But and again, it's, to me, I would just tell you not to buy it. I wouldn't tell you to short it because it's tough. It keeps going up. But what you want to do is when you have if you want to get into it, and also it's expensive because of the margin and all that, that's why it says it's not fun there. There's so many other stocks to trade that it's no fun to play Amazon. Oh, is that it? Okay, great. Now, let's see, what else can we do then? All right, let's take a look at the overall market, see if there's anything fun to play. All right, so 1210, not making it there. See, okay, pink lines, right? Pink line, pink line, pink line. Everybody's stuck at their pink lines except the Russell, which is crazy. We know the Russell's crazy, so we take it with a grain of salt. Nikkei, not even that, they're pink line. Dollar, coming up. Dollar's moving up. Okay, that's putting pressure on everybody. Oil sales at 41. Gasoline, 135 and change. Doesn't make it. Natural gas, don't ever get in the way. Don't ever poke natural gas. As we call it honey badger now. It's just like a dangerous little thing that never dies. It's a shame. I saw this morning and I was greedy and I didn't play it, but I knew that was a good number. I called it out, but I didn't play it. It was just a freaking amazing play. Look at this, 273, 10 cents in natural gas in 1 day, an incredible amount of money. So it's also $100. It's $100. It's also $100 a point. So it's $1,000 a contract on that one. Really nice move. Anyway, so during the day, you can look at these charts. These are relevant. Everybody's at their middle point here. So it's not like we're having a bullish run, really. Everybody's just making it back to the little middle spot. The Russell's a little over, but if the Russell fails its pink line, then I would take any pink line that's left and short it. Because the Russell's clearly been leading us around this morning. You want to see the dollar go higher, and that will put more pressure downward on things. Where's gold? Here's gold. Gold's already come down a little bit. Silver down a bit. We're kind of short silver in the short-term portfolio because we did a thing. What do we do with silver wheat? Look at that. Oh, is that current? Yeah, probably is. 77%. So our 1 year anniversary is Monday. Monday is our 1 year anniversary for the options opportunity portfolio. We're up 77%. That's not bad for a first year. And we had a terrible start. The first quarter on the options opportunity portfolio, I think we were down like $20,000, $30,000 for a little while. Let's take a look at the S&P and see why. What happened to us? It's just a bad time to start a portfolio. Oh, yes. That's why. Because see what happened here is because obviously I started a new portfolio. I wanted to buy stuff. So we bought positions. Obviously, everything we bought that was bullish got crushed. And we had not yet established hedges. We only just, we just started buying some things, and everything we bought got completely crushed. And then we put some hedges on, and the hedges got crushed on the way back up. So it took us a while to recover from that. But then, fortunately, we called this one right and started rebuilding our balances. So that's what happened in the short-term portfolio at the beginning. There's nothing worse than a violent market move when you're first starting a new portfolio. That's why the long-term portfolio and the butterfly, which are our more conservative portfolios, we went very, very slowly. Oh, see, this Q&A thing's not good. Craig, which study on TOS gives you the pink lines? That's pivot points. Do not ask questions there, though. I don't even know how you get there. Yeah, it is a pivot point, so. Let's see. What were we doing? I forgot now. Oh, the thing. Anywho, so here's the 5% portfolio. Now, we haven't done anything really. We've made very few moves in the 5% portfolio recently. And why is that? Well, because frankly, these are the same positions that a month ago were only up 60%. So they're making 10%, 12% in a month. So what should I do? Why would we want to change them or do anything with them? And also, we have used up a lot of our margin. It says minus 62,000 because this only gives you, the margin requirement is 153, and we have 175 obviously in the portfolio. So really, we have 350 of buying power of ordinary margin. This thing treats it like an IRA. I don't know how to change the setting on that. So it shows a lot. It shows 175 less buying power. But either way, we're using like 2/3 of our buying power currently. I do not want to use more than that. Now, a lot of that is in the WSM, these short puts. So if we pull the plug on those, we free up a lot of buying power. But the point is anyway. So we used, although we have so much cash, $90,000 cash on the bottom line, we do have a lot of money tied up in position. So this is as much as I want to be invested right now. What do we have? We have SJB, which is the short on a junk bond. We have the TBA longs, which is a hedge. We have the TLT shorts, which is a bet. We have ABX, free money. That'll be 338 coming. SCX is 250 coming. Target is also so far in the money. That's 1,500 coming. So here's $2,000 coming our way. Williams-Sonoma, don't know. Could go either way, so we won't count that as anything. Sotheby's is, this is a lot of money. Holy cow. We have a 15.23 spread, and they're at 31. So they're miles in the money, and that's a $8 spread times 40, $32,000. Currently, the net is $26,000. We have $6,000 coming to us on this trade. Here's another hedge, SQQ. Here's Apple. We have 85,110, which is 25 bucks. Times so it's a $50,000 spread. Currently, the value of this spread is nothing. Is 30.27. So we have about $23,000 coming to us on the Apple spread. All right, and that's at 110. I mean, we're very confident this is going to go through. So this is going to double and make it $27,000 if we do nothing. So when you're going to make, I lost track already, but when you're going to make 30, well, so this was a big number, right? This was damn it. 32,000 minus, and it's at 6,000. Okay, so this one plus this one is 30, and couple. So just these couple here so far are $35,000. Okay, so that's 35% that we already have that we'll make next year. How much do we need to make? I mean, how much money do we actually need to make? So doing nothing is the right thing to do when you're going to make 35% doing nothing on just those trades. And we got a whole bunch more down here. So here's Baker Hughes. This is the August spread. It's well in the money. This is going to expire in the money. And this is going to net out for $3,000. And currently it's showing 49 minus 29, about 2,000. So $1,000 coming on that one. Here's a longer-term Baker Hughes, which is the 35.55, and also nicely in the money. So it's 12,000 in the money now, but yet, look at the net. The net on this one is $1,000. Or it's maybe 1,500, whatever the hell. But anyway, the net on this is like $1,500, and it's $12,000 in the money, and it could potentially be $20,000. So this trade can make $15,000+. And where are we here? 35. I don't even know anymore. 50. So here's like $50-something thousand at this point already. The Disney trade. So we're already set up to make this money next year. This is what's very important to understand. So we're not doing anything. We're like a landlord. What do? You sit there and you wait for the guy to pay your rent check. There's really nothing else to do right now. And there's nothing wrong with these trades. They're all good trades. Here's Disney. Disney is not in the money, except, we play it that way, though, because we shorted the August hundreds. We do have earnings coming on them, I think. This is a $7,200 spread that is currently valued at, about $3,000. So we have $4,200 coming on this one, and all they have to do is get to 100 by, I'm sorry, not 100. This is complicated because it's not a real spread. But this thing can be very, so from 250s to 96 is 5,000, let's say, and what I say they're at 3,000. So there's a couple of thousand coming here, but what we're going to do is when these expire, we'll turn that into a spread. GOGO is not doing well, and so we don't count that. This is not making any money, but currently it's a $5 spread. But really, that's not the point. The point is that we spent negative money on this. See, that's 330 plus 425. No, I'm sorry, 455. So it was a 55-cent credit, and currently it's showing about even. So basically we're up a tiny bit of wait. Why does it show that? It's weird. I must have done the math wrong somewhere. Oh, it's not, I'm sorry, it's my fault. It's not the same amount of puts. So 8 minus 2 minus 3 is 5,500. So 25. So it's a $2,500 net spread, and we have 20 of them. So we need to see GOGO being more than $1.50 in the money. We need like $9.50 on this one by next year. So this one's a loser. But look at that. Look how far we had to go down the sheet. We went this far down the sheet to find one loser, and it's not really a loser. I still have faith in them. Copenhagen probably not a loser, but about where we started with this one. Is it in the money, though? No, this one's not in the money, so we're not going to count that as making any money. IMAT's doing very, very well. I'm going to leave that alone, but that's also nice. That's actually probably showing its full potential right now. Not full potential, but full value. It's fairly valued at the moment, put it that way. These puts will expire worthless, and we'll pick up another $800 there. Lebu, this is our new Lebu trade. Totally in the money. So this is $5,000 net, and currently it's valued at 35 minus 21. I'm sorry, 18.5 minus 21. So about 3,000. So currently it's valued at $3,000, and it's. I mean, how is it going to lose? It's It's massive. It's 50% over our target. Wow, that's crazy. Serious? When did that happen? Weren't we worried about them at some point? Silly us, right? I love that. This is my new favorite ETF. Jeez. No wonder we bought more. And by the way, look, this is the whole point. We're fundamental investors. So when did we buy this? 6:30. What does the chart look like on 6:30? Dun, 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 dun. Damn it. There it is, right? June 30th. See? What do I do when a stock goes against me? Okay, we already have this position. And don't forget they have a split, a 4-time split. So these are 36 calls. So this is a 20-36 spread. Is that right? Yeah. So they had they had a 4-time split. So this used to be the 20-36. Now, this is wrong though, because the thing is that we only have 2.5 because we got a 1 to 4. So we only have 2.5 of the new one. So although it seems like a great play, we only have a little tiny amount of them at 20.36. But still, we're still going to make the $4,000 we intended to make on this trade when it closes out in September. So when this trade went bad, theoretically bad, because down here it was closer to 20, where that trade would be worthless. And we had a whole conversation about this at the time, and I said, well, the reason that biotech is down is because Vertex destroyed the entire biotech buying universe, and everybody was bailing because Vertex dragged the indexes down. And everything good stuff got sold with the bad stuff, and it started a cascading failure in the IBB. So biotech stocks went out of favor because of Vertex, but there was no reason for them to be out of favor. Everyone didn't cheat. They did. And them and the blood people, also the other one. So there were two scandals at the same time, and we had this cascading thing anyway from last year. So that's why it was a bargain in the first place. And all it took was just people to start realizing that, and for a couple of good breakthroughs to come, good earnings, and so on and so forth, and boom, you're off to the races. That was easy money, man. It should have been. I think that was didn't I call that my trade for the second half of the year? I think I did. Correct me if I'm wrong, but I think I actually did say that was the best trade I saw for the second half of the year. Anyway, so that's what a fundamental investor does when a stock they like goes down. They buy more of it. They don't run away. They don't close the trade just because other people don't understand how to value something. Okay, if I'm at a Mercedes dealership, okay, and there's a there's a 350 SUV that's like $50,000 or $60,000, whatever they cost, and the guy's selling it for $40,000. And then and then people hear that this guy's selling for $40,000, and they go, "Oh, it must be something wrong with it," and they start selling it for $35,000 and $30,000. All right, what do I do if I already have one? Do I sell mine for $30,000, or do I buy one because I know I like the car? And why is that? Because I'm not a moron. Because I know the value of the Mercedes. I don't care what people think. I care what I think, okay? And if you're going to be a real investor, you've got to have that thought. You've got to have a value, and you've got to know what things are worth that you're buying. And then, conversely, don't buy things if you don't know what they're worth. Don't just buy stuff. Buy things you understand. Buffett says this all the time. Stick to things you know. Stick to things you understand. The more things, as you get more experience, you will understand more things and you will expand your universe of trading. When I started, I traded just basically only tech. I love tech. I was really into computers and crap when I was young, and I just basically started out trading tech stocks almost all the time. My whole portfolio was tech. I don't think I had anything that wasn't tech in my portfolio, which was fortunate because we had a tech boom. But, you know, I mean, I didn't see why would I trade in this. And my brokers used to say to me, "Oh, you should diversify." And I'm like, why would I diversify? I said, what's better than computers? Turned out the internet was better than computers, but who knew? But that was something I didn't understand. So I like the hardware. I was trading hardware companies. Anyway, but so what if you missed something? I did very well trading my computer stocks. All right, Love and Liquidate is what we know. We love them, right? Love and Liquidate is so far, well, we have a $10 call. It's $550 in the money. We have 15 of them, so that's $7,500. Currently, this trade is valued at $7,000. That's interesting. So that's it's fully valued to where it is. This is unusual. Our maximum on this, though, is $12,000. So it's currently $7,500, and it could be $12,000, and we have no reason to think we're not going to get our $12,000. So we're not changing it. Here's Marvel. Marvel is totally in the money. So totally in the money means we're going to make 5 times 10 is $5,000. Current value of the trade is 64 minus 4 is about 24. So this is about half of what it's going to be worth in a year. But yeah, I mean, we're doing this like, here's, where were we? We were like 35,000, and we're like 35.40, 45.50. You know, we're like up around $50,000 coming to us with the trades that are currently in our portfolio. You don't change that kind of stuff, right? SunPower. Oh, another winner. Wow, that's a good one. Actually, it's funny because net hasn't moved. I guess because the way we bought it. Here we have a $5 spread. This is going to be $5,000, and currently it's worth nothing. It's basically a flat thing, so this will be a $5,000 gain. Taser should be doing really well. Taser is completely in the money. It's a $7 spread times here is $14,000, and 10 minus 1,500, so about 8,500 out of 14,000 here. So we have another $6,000 coming to us on this one. Twitter just popped. This is now in the money. This is now 100% in the money, like a few cents off. This is a $8,000 spread that currently is worth 4 minus 2, so about $2,000. So this is, I talked about this morning. This one's going to be up 300% if it holds. So why, even though it's not as good as our original net entry on this is $500. But even at $2,000, it's still going to be $8,000. It's still a good trade. You just missed $1,500 of the gain so far. TZA is another hedge. UNG, Damn, UNG is not as in the money as it was, but it's still on track as far as I'm concerned. But even so, it's $350 in the money now times 20 is $7,000. So this is already $7,000, and currently the net is the net is negative. Look at that. All right, so we have a negative net on this trade. It's minus. It's 10,000. It's minus $2,400, and it's going to be worth $7,000. This is going to gain $10,000. That's the UNG, and then Exxon is a slam dunk. I think it's shooting up. So this, but again, this is more of a bet, and it's worth zero right now. It's flat to where we bought it. If we get the it went up $2 today. This is all we're at. How is that possible? That's not fair. This is that Zika company. Oh, look at that! Come on. What's it take? Anyway, I'm hoping we're going to get to like here about maybe 33, 35, and then I'll probably be happy to cash this in for $8. If we cash that in for $8, it's $8,000, and then the puts will expire worthless, and we'll clear $8,000 off our initial $4,000 investment, so that'll be a double. All right, so there's $60,000 next year coming to us. Without, I just go to sleep. Just shut it. Just put it away. Don't even look at it, and then that's it. It'll be $8,000. It'll be $60,000 more next year, and we'll be up to like $250,000. That's if we don't touch it. Now we're going to touch it. But the point being, why would what? There's no desperation to do something, is there? It's already set up to make $60,000 more. That's how we run our portfolios, okay? And the long-term portfolio is the same kind of thing. I mean, the long-term portfolio is going to make at least $100,000, maybe $150,000 next year. And look at this son of a bitch thing. It's up 110%, over $1,050,000. And it's the same kind of crap. All these guys, 3, 6, that's 10, 15, 20, 35, another 10, 45. 45,000 just on the short puts. So we have 45,000 coming to us there, and these we sell every month. All right, and I'm not going to go through these, obviously, there's too many. But look at, it's the same deal as the long. They wouldn't be there if we didn't like them as much as we like the OOP plays. And these are bigger plays. So if the OOP with less positions than this was $60,000, this thing's got to be $120,000. So 120 plus 40 or whatever I set up here is 160. So this thing's going to be good for $150,000 if we leave it alone. But we're not going to leave it alone. We're going to do something that will make more money. We've got 12 months to figure out other ways to make money. It's not complicated, and these are our low-touch portfolios. The butterfly is much more conservative. It's still up 177%, but it's been running longer than the LTP. The butterfly is up 177%. Again, we don't touch it. Once a month, we make an adjustment. Very simple concept. This is all using just our Be the House concept where we sell premium. And what's the last one to look at? The short-term portfolio. So 390%. This one took a hit. It was over 400%. But because this is where all our bearish bets are, these are all protecting the long-term portfolio. With $1 million long-term portfolio, we're protecting with this one. Accidentally, we're up 400%. We didn't intend to be up. This portfolio is not supposed to be up. This portfolio is supposed to be down, or we try our best to keep it even as we hedge the long-term portfolio. So if we keep this portfolio even, it means we have 3 hedges on the LTP. So what do we do in the short-term portfolio? We always take our hedges, but then when we have a lot of hedges, we then will pick out some other bets we could make in the short-term portfolio to offset the hedges. All right, so we don't put, we'll make all kinds of crazy bets. And the more margin we have now, look at our buying power. We're using no margin, no nothing. We're using $30,000 of margin from trades we have now. So we have all the buying power. We have basically $1 million worth of buying power, pretty much. So margin. So we make all our crazy margin plays in this, like selling, like we were talking before, selling Amazon $750 calls to idiots who think they're going to go to 800, selling Google $900 calls to people who think they're going to go up over 1,000. You know, because look at this. I mean, Google, for example, a Google $900 call. GOOGL. Okay. So Google's at $800 just about. And if we were to sell the September, no, let's go to January. So January $900 call. Well, that's not enough money, frankly. $10. I wouldn't sell that for $10. Oh, how much is the $800 call? $45. All right. Well, you can sell the $800 call for $45. So basically, unless it goes over $850, you make $45. I wouldn't make that play because the risk is not worth it. But I'm just saying, as examples, we can do things like that, because what happens if you do that, though? If you sell the $850 call, your margin is going to be pretty large. Oh, there is no $850. I'm sorry, the $800. If you sell the $800 calls, doesn't matter. All right. $80,000 margin. But you're going to collect $44,000. So you're going to make 50% of your margin, and that's not portfolio margin, by the way. So if you have portfolio margin, you would obviously pay a lot less. But you're going to collect $44,000 up front, or $45,000 up front. Your margin is $85,000. But if you're not using the margin, what do you care? I got $1 million worth of margin sitting around. I don't care, and it's not even portfolio margin. In portfolio margin, I got $2.5 million worth of margin laying around. So why would I not allocate $80,000 to make $40,000 in 6 months? There's no reason not to do it. If I felt strongly about the trade, I don't. Okay, I think Google's overvalued. I think, but it costs too much to short. I'm not going to pay $15 for it, $700 short. And Amazon's the same, unfortunately. It's just so freaking expensive of a stock. I think if Amazon was a normal price, then it would be great to short. In Amazon's case, well, people are real idiots with Amazon, so maybe there's better pricing here. Yeah, look at that. They have better pricing than Google, because I can sell the $800 calls here for $35. So here I close $35,000, same deal though, $60,000 in margin. It's the same margin deal, but I have a $50 buffer here. With Google, I was selling half the money. Here I'm selling $50 out of the money. They got to go up more than 10% to make me pay this money back. And by the way, I always think it's a good thing. I automatically always say, well, I could offset that with a short, with a short put sale. And the funny thing is, as soon as I thought that, I'm like, no way would I sell a short put on Amazon. And if that's the way I feel when I'm looking at the chart, I already know I like the short call, because I'm not willing to take a chance on owning Amazon at any of these prices. I think I wouldn't be comfortable with these. I would not be comfortable selling these puts, the $600 puts, the $615s, whatever. Here, $600 puts. I'm like, for $10, I don't want to risk owning Amazon. That's how much I think Amazon is overpriced. So that means I really like the short call. but like I said, the thing is, even if I'm 90% sure, because it's a $750 stock and a 20% move against me is going to pop this thing $150 to $900, and I lose $100, I'm not willing to risk that. It's $100 to $10,000 per contract. I'm not willing to risk that. There are many other trades I can make where I don't risk losing $10,000. So as much as I like the idea of shorting Amazon, I won't, because it's too scary. Russell coming down. Wait a second. Oh, I don't know what you're looking at. Are these not updated? No, they're updated. Okay. Dollar shooting up. Okay. Okay, it's got to get through the little red line for one day to be shooting up. It does look like, I mean, look, I will be surprised if we don't have a sell-off into the afternoon. We'll see what happens. I don't see any reason that why should we be up? We should be down. Europe was flat. We'll probably be flat. We'll see what happens. But I think the dollar, again, I think the dollar bottomed out, and there's going to be some pressure from the dollar keeping things down. All right, what else did I miss? A Tesla earnings play. Nope, have no idea what's going to happen with them. I don't like them. I hope they do well so that the stock pops up to some stupid level and we can short it. But at the moment, I'm not really in love with the position. We already have a short, by the way. In the short-term portfolio, we have them because I don't want to miss the party if it does. We have the September 160 puts, so I already made a bet on earnings. And yeah, the 160 puts are miles out of the money, but that's not the point, because if they do crash on earnings, these will get jacked up for a day and they'll go over $2. You know, so we'll sell as they're on the way down. I don't expect them to actually get to 160, but if we get a nice $20, $30 drop tomorrow, then these things will probably go up to like $4, maybe $3, $4, whatever. We'll make our money. So it doesn't have to be your target. You just have to have a reasonable expectation that they'll increase in value. But no, I wouldn't. Other than that, other than like a speculative thing like that, I really wouldn't make a Tesla play right now. What are you expecting? GOGO earnings. Another one. I have no clue. I like GOGO. I'm bullish on them. I think that their earnings are going to be mediocre at best. Probably not a miss. But all the stuff they're doing is long term. So I'm not really, I wouldn't be surprised if they even don't do well. But it's more, I care much more about what happens in the conference call than what happens on the earnings report. Oh, I like them down here. Holy cow. Yeah. So GOGO is a good play. I would honestly, I like this. Jeez. Wow. I didn't know they were so low still. Let's see what they come in at. We have them in something, don't we? Or did we get rid of it? Not there in the OOP. $78. Hey, we made 1.4% while we were waiting. Love that. Oh, here we are. Oh yeah, okay, great. So I like this trade. Yes, I like this trade the way it is. It's 2018. We sold a $10 put. That's an aggressive sell, so I really think it'll be over 10. We bought the $8 call and sold $13 calls, and the net of this spread now is 0, basically. It's 38 plus 2 is 58. It's a $500 credit to take this spread. So I still endorse this exact spread as an earnings play. I in no way, shape, or form would play the earnings themselves. But I think 18 months from now, this company will be in fine shape. All right, and we'll find out tomorrow. And by the way, the nice thing about that is if it turns out that tomorrow they disclose some stuff that's bad and blah, 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 those long plays, they don't lose all that much. So we'll take, we'll take a hit and get out if it's somehow disappointing. If the facts change, we'll get out. G Clay says 6,000. I wonder what that was in reference to. I have no idea, sorry. All right. Oh, where are we? I made a mistake and got 20 Apple, 110 calls, and have only 10 Apple. Ugh. Wait, I don't get it. So, May, where do you, think? Apple can pull back too for me to go long on the 1825 calls again if you still think we get a small correction. I would, all right, so my understanding here is that you seem to have sold these. And you only owned these, so you're taking a hit. But you know what? Apple's not at 110. All the money you think you're losing is premium. I would not worry about it at all. Your 85 calls is deeply in the money. That's real value on the 85 calls, and this is fake. So I wouldn't worry about it, and frankly, I don't know when, August, September, October, probably sometime maybe September, October, I believe you'll see the Apple 2019 come out. And what I would do is look to pick up a 2019 spread to cover your 2018 110 calls. Okay, so and again, obviously, check. We'll talk about it over the time. But if Apple looks like it's doing really well, like its next earnings are really good also, and the market's still going up, then great. If not, though, consider it very good protection on your longs that are in the money. That's all. But the 110s, I mean, I don't know what they're at, and it depends what you sold them for. But don't spend money when you don't have to, and don't chase things. Those are basic rules of thumb. So you've got, what did you say you sold? 2018? Oh, so you're all in 2018. So the 2018 110 calls are $12. You got the 85, they're $24. All right, so, but this $12, your 85s are almost $20 in the money. They are $20 in the money. They're $20 in the money. So $20 of your 24 is real money. All of this money, the short 110s. So this is $10. All of this money, all $10 of it is fake. It's speculative premium. You don't owe this to anybody because Apple's not at 110. I wouldn't leave it that way long term. But like I said, I would more likely, unless Apple goes over 110, and then I would say probably you want to do something. But if Apple stays at 110, or if Apple stays below 110, I would just let the premium burn down until, and not forever, but until the 2019s come out. When the 2019s come out, then you could take a spread like the 100, which is 15, 125, bull call spread. This is a $10 spread. So instead of buying these back to 10, you could buy 10 $25 spreads to cover them in 2019. Then you're set up to make more money, and you've got the protection. And at that point, I would probably consider rolling some of them back to something that expires sooner, like June. How could that be June? Oh, that's June 17th. That's what. How confusing. See how many Apple rolls those options in real fast. Okay, you see how the January 110s are $4? I would roll, not now, but I would roll half of the calls once you establish your hedge. Well, you could do it now, actually. You could roll 10 of these over here. Because obviously these are going to expire in just, how many days? In 170 days, so in less than 6 months. These are going to expire. So instead of having a $10 call that takes 18 months to expire, you're going to take, you sell some of these that take 6 months to expire. So in theory, you could sell these 3 times instead of once for the other ones. So you get more actual premium out of these. So what I would do overall, my plan for the play would be to take the 2019 100, 125 bull call spread to cover the 10 extra positions, and I would roll 10 of the 20 positions to the January 110s, where hopefully they'll expire sooner, and then you'll just have the 10 longs, and you can decide what to do with that at that point. Hey, am I still online? Hello, testing, testing. Oh, okay, thanks, Brian. Okay. That was weird. I got a message saying that my connection was lost and being reestablished. Okay, good. I never saw that before. Wow, I'm getting way behind on questions. All right. Sound only, cannot see the screen. Shit, really? Oh boy, okay. What do I have to do? I don't even know what the proper procedure is for this. All right. I have to assume that something happened to my thing. All right, I'm going to cut this screen, and I'm going to come back in a minute. I'm going to reestablish my connection, okay? I'll be back in a minute. I just realized I lost all the freaking questions by doing that. Can you guys hear me? Uh-oh. Okay, yeah, let me start the screen sharing app. Think of that. Oh, where's my screen sharing app? Oh, here it comes, okay. So it's still recording. Yeah, I know there's no screen, and we're starting it back up. Okay, now we should have screen again. Okay, so I have no idea where I was. That's the thing. So if anybody has an important question, rewrite it now or forever hold your peace. All right. What else are we doing? Oh, looking at the market, right? All right. Everybody, see, he's coming right down to his line. Everybody's a little falling apart. NASDAQ is the least falling so far, so that's the one you want to look at as far as a trade. Also the Nikkei, though. But the Nikkei, see, here's the thing. The Nikkei is not a good short if the dollar is getting stronger. The dollar is going up. So that means the Nikkei, even though it usually follows the indexes, it's a little bit not as good of a short if the dollar is going up. So if the dollar is flat or down, then the Nikkei is going to follow the indexes. If the dollar is going up, the Nikkei is still going to kind of follow the indexes, but probably not as fast. Because the Nikkei loves a strong dollar. So we'll see how that goes. Anyway, none of this is exciting enough to really call a play on, so I wouldn't. Nothing. I see nothing exciting. Sorry about that. But if I was going to do anything right now, it would be shorting these guys below 47.20, the NASDAQ. But none of this looks very exciting right now. And the dollar, you want to see the dollar pop here to really confirm that this is a good bullish move. Not only that, though, but you want to see the Russell stay at this line, which is 1205. And if the Russell holds 1205, then everybody may come back over. And nobody had a question. Okay. It looked like there were a lot of questions, but I guess not. We looked at all our portfolios? Yes, we did, right? So it's all good. I just did a review. I just went over stuff, not a full review, but I went over everything recently. And basically, that's the thing. I mean, I look at these portfolios. It's the same thing with all the portfolios we did with the 5% portfolio is, what am I going to do? How can I change it? It's going to it's set up perfectly to make $60,000. So probably, if we're smart, we'll make that $60,000, and hopefully another $60,000 we'll figure out how to make over the course of the year, and we'll have a really fantastic year. So that's my plan. But literally, the 5% portfolio is meant to make $5,000. This is the options. I'm sorry, it's the OOP, except that was the original name of it. The original purpose of the 5% portfolio was to take $100,000 and make 5% a month. And obviously it takes more than a month to build something like that. But at this point, literally doing nothing, I expect to make $5,000 a month. Literally, it's set up already to make that kind of money. That's what we want to do with a portfolio. That's what you need to learn how to do. Build it, balance it, maintain it. And it's not that hard. We have 4 portfolios doing better than that's our slowest portfolio. Okay. I don't know what else to say. I mean, this is well balanced. Oh, I know what we wanted to look at with silver wheat. Sorry, but that's while it hit my brain. In the long-term portfolio, we had a weird trade on silver wheat. Oh, or was it the short-term portfolio? No, here it is. Oh, boy. Oh, no, here we still have calls here. That's not the same play. This is bullish. There's nothing wrong with that. Must be in the short-term portfolio then. Oh, no. I'm sorry. It was a long-term portfolio, but I don't remember when we called it. When do we look at these things? Hang on, I got to look this up on my other thing. Sorry, this is important. Unless I meant to call it and I never did, which is possible. Nope. When did I say this? On the 14th, in the short-term portfolio. Hang on. Let's be responsible and buy back the puts and take the money for the calls. Okay. Oh, I know why I didn't see it. Because it moved up here. There it is. Okay. All right, so we shut that trade down. That's why it's not a non-issue. We're only left with these. These are stupid. We should be taking these off the table. Why did I leave these? So I left those because we don't need the margin, and there's no reason to pay $230 to close it. But I can kill it anyway. All right, so silver wheat is gone. I was going to say I think silver's about done here, and it's toppy. So we did the right thing. In fact, I said that back on the 14th. I said, let's be responsible. So we missed the tail end of the rally in silver. I called it on the 14th of July, and it is now August whatever. So let's see how dumb I was. No, not bad. Yeah. I mean, I called the top here. And it did fall. Now it came back, and now it's toppy again. So, no, I think I stick with my thoughts is, yeah, I mean, 20, the red right here is about right. Okay. All right, so that was no point to that. All right, SKX, are we still bullish on Skechers? Did they have earnings? Are we waiting for earnings? They had earnings. Yeah, at this price, I like them. That was a new trade, wasn't it? Didn't we just sell puts on these guys or something? So, yeah. I mean, it's fashion. I know it's not very fashionable seeming, but it's fashion. I mean, these things go in and out of style, and you have little ups and downs in the industry, but Skechers is an established brand. It's like Adidas. Like you would have kicked yourself if you had bet against Adidas when they were down, right? Because they came back strong. In fact, even Converse All-Stars are coming back now. $23.30 short puts. Yeah, I like that. I like that trade. Again, you got to have a value in your head And you sold the $23 short puts, SKX. So I think we had trouble getting our price. Not now, 450, 460. Anyway, so you sell these puts for $4 or $3.50 or whatever we sold them for. Your net price is $20. So, first of all, you should never sell them unless you really want to own them for $20. And I mean really like, oh God, I hope I get to own these for $20. Not, okay, I'll own, you know, it should be something to say, I hope these things go down another 10% so I get them for $20. Probably that won't happen because we took advantage of this sell-off, said there's enough of a company here that I don't think it's going to go much below 20. We sell the $20 puts when we have the opportunity, or the $23 puts. So if it holds here and never gets to our price where we get to buy it cheaply, then as a consolation price, we're going to make 15% of what we would have if we bought it here. That's how we trade it. That's what the long-term portfolio is full of positions like that. I think it's in the long term. Maybe I didn't add it yet. Let me see if I don't know if I can put that adjustment in. Oh, there it is. Yeah. That wasn't a big trade. I mean, for the LTP, it's small. Oh, we sold them for $5.10. Are you kidding me? Why would you not want to do that? Oh, $25 puts. I see. We sold the $25 puts. So I was even more aggressive than that. So anyway, it's the same concept, though. We sold the $25 puts for $5.10 on SKX. That's not SKX. So here, when they were coming, what I thought was the bottom, of 26 or whatever it was, right about here, we sold them for $5.10. I decided that 25 was a fair price. And I think that after this little panicky thing subsides, it'll come back and go over. If it's over 25, we're going to get $5. That's 20% of 25. All right, but our net is 20. So we're going to make 25% of our potential net of 20. So even if I have an IRA account, it's freaking 20% return. Even if I'm taking a full hit in the IRA of our margin, I'm still getting 20% back on my margin. That's a hell of a lot better than putting it in a T-bill. So that's, I love trades like that. And if it goes badly, then fine. I'm happy to own Skechers. I'm happy to be a long-term investor in Skechers. It's only 1,000 shares. It's only $20,000 in the long-term portfolio, which is it's a drop in the bucket trade. But it does drop $5,000 in our pocket for playing. Are you planning to start a new portfolio in September? No, we're going to keep this one going. I want people to understand how this works over time. And like I said, you can take every single one of those positions, or look, exactly what I just went through now. You can read them and say, well, how much is the potential of this thing? How much is it now? And you can pick some of them and just add them if you don't have them already. It doesn't matter. It's not about following the portfolio exactly. It's about basically, it's about learning how to run a portfolio. That's what's more important. So, and like I said, there's really no positions there I don't like. They're all good, otherwise they wouldn't be there. They had earnings last week. Yeah, okay, that's right, that's Skechers. So they were fine. We looked at the earnings, and that's what made us decide to play. It wasn't as bad as people were reacting to. We love trades like that. I love it when people have bad earnings. I love it when earnings are considered a miss, but we go, it's not so bad. Oh, DBA. Thanks, Mike. Very important. Holy cow. We were looking for a trade in DBA because all the food got killed. Food got crushed. Look at that. And why is DBA down? Because if you look at these charts, grains, weekly. Okay, this is weekly. Okay, so let's do daily. Look at this. In the last couple of months, man, massive, massive, massive sell-off. all the way across. That's grains, and here's other soft things. So everything but, okay, cotton's up. Not good for shirt makers, by the way. Orange juice got expensive. Coffee got expensive. Not good for Starbucks. But you know, it's mostly the grain area that killed DBA. So that's fine with us. There's lots of the basics here. And it's a great time to buy DBA, which is a fantastic inflation hedge. So at 20, which is where I love to buy DBA long term, we picked them in the fall when they were down here also. In fact, this is where I think there's an inflation hedge down here. So we're back to a nice entry on DBA, and if we go to DBA, probably the same trade I'll probably end up picking the same trade, but let's take a look. But now think about this. This is what a professional hedger does, okay? So you spend, let's say, $300 on groceries every week. Okay, that's $15,000 a year. Oh, you probably don't. That's my family. We shop at Whole Foods. I don't know, whatever normal people spend on food. I don't know, honestly, 150, I don't know, whatever. But all right, let's say you spend $200 a week, just to make my life easy. So it's $10,000 a year on food. So food doesn't go up 20% a year. So you're not worried that you're going to lose $2,000. That would be a lot of inflation. You probably it would be nice if you could make sure you don't spend an extra $1,000 this year on groceries, right? So that would be a 5% gain. I'm sorry, no, 10% gain. So if food goes up 10% over the next 18 months, you would like to be hedged against that extra expense. So to lock in your position that you have, your position is you're a buyer, a regular buyer of food. So we don't want food to go higher. So what you want to do is you want to get paid if DBA is over $20. And the way you do that is you just set up a very simple spread, and you say, okay, well, what could I get here? I can get the 19 for $2.60. I can sell the 21s for $1.60. So that's $1. Now we're at $20.55, so you're 50 cents out of the money. So if you do 10 of them, it's $500. I'm sorry, it's not $500. It's $1,000 for 10 contracts. So you're going to put $1,000 down, and that $1,000 has $1,000 of upside. And so here's what could happen: either food costs go up, and you're going to make $1,000 on your contracts, right? But your food will cost more, so you're going to be even. If DBA stays flat, you're going to get half your money back on your contract, $500 back on your contract, and you will pay the cheap price that you're happy to pay for food right now. If DBA goes down, that means your food costs are going down, and you will likely save $500 to $1,000. So your cost of your hedge is likely to be $500 in a negative outcome. Okay, it's probably going to cost you $500 for the hedge. Now, how can you offset that? Since you're always going to buy food for the rest of your life, it would not hurt you to own some DBA as an ETF, right? Because it will always protect you against the inflation of food. And then, obviously, you can sell calls against it and so on and so forth. Like for example, if you owned it now for $20, right? And you sold these puts for $2, you would collect, let's say you had $20,000 worth of DBA and you sold those puts for $2. That would pay for all your food. That pays for a year of food, selling the calls. You sell the $20 calls against the DBA stock and you paid for your year of food, free food. This is why rich people are so rich, because they get to do things like this. So meanwhile, while DBA is down, I would certainly sell these tasty puts for $1. Now, sensibly, in the context of what I'm talking about with this $1,000 hedge, you could sell 5 of them. You don't have to sell 10 of them. You could sell 5 against your 10 longs, because that's going to take out the $500 that you're probably going to lose. So in negative consequences, you will lose $500. So now you're in the trade for net 500. So what happens? Now, if DBA goes up, you make $1,500. If DBA goes flat, you're even on DBA and your food prices stay the same, which is what you wanted. You wanted to lock in your low food prices. If DBA goes down, you're going to lose $500, but you're going to certainly get $500 back at the grocery store from cheaper food prices, and you may be then assigned to own 500 shares of DBA for $10,000, but now you have that long-term hedge against inflation at net 20, and if you then turn around and sell these puts for $2, you'll pick up $1,000 in your pocket to sell the calls. Sorry, you think, but you sell the calls once you own it for $1,000, and then basically you get $1,000 a year as a dividend for owning DBA. All right, so you might have to play that back a few times in the replay, but in the Secret Santa's Inflation Hedges article for 2016, I laid out the same basic scenario. This is how professionals hedge. And you can do this with anything that you know you're going to buy. And really, it's a very good article, that Secret Santa's article, if I do say so myself. But I lay out that premise for if you're buying a home, if you're buying food, if you're buying gasoline. I laid out a premise for how to hedge against all these things getting more expensive. And anything that you're going to repetitively buy, it makes sense to have an investment in it, right? You're the buyer. You know that you're the audience. You know you're going to buy oil every year, right? You know you're going to buy gasoline. You know you're going to buy natural gas for your house. You know how much money, for a fact, how much money you're going to spend on your natural gas bill. You spent $4,000 last year, you'll spend $4,000 next year. That means your bill is $4,000. You don't want it to go to $5,000, so you want a $1,000 hedge. You construct something similar to make a $1,000 hedge. But this DBA thing is very simple, right? And like I said, you know, when I said that, you wish you owned $20,000 worth of DBA, because then you would sell $2,000 worth of DBA calls, and you get all your groceries are free. There's your grocery bills taken care of. So that's what you do with these hedges. Your worst case scenario is you're locking in a very low price, and you don't lose. Because if DBA stays below 20 for the next 5 years, and you say, oh, son of a bitch, I've got these 500 calls, and I bought them for $10,000, and now they're $7,000 5 years later, and this thing sucks and it's not doing me any good. Well, it didn't do you good because your freaking food costs fell for 5 years, and you saved much more money than you lost on the hedge. The idea is to control your expenses on real things that you buy and use every day. That's what hedging is about. And it's the same with the portfolio. Here's the thing now. Follow through the logic on our portfolios. Because we run this be-the-house system, because we're always selling premium, right? Our stocks don't just lay there. They make us money all the time. They're out working for us. Instead of being idiots who are betting that things go up and down, we say, no, we're not playing that game. We'll take all the bets, and we'll collect all the premium. And so we constantly make money. And what we're hedging against, when we hedge, is we're hedging against our underlying portion of the stocks, the main parts of the stocks that we own, that we're renting out to other people. We hedge against them losing value or hurting us in some way. That's what our hedges are for. They're protecting something that generates an income. And that's how you manage your assets. It's the same with everything. Even life insurance is the same. You have to look at, whenever money's involved, you say, how much can it make me? And you say, how much can it make me? Even you as a human being, how much will you make over the next 20 years? If you're only going to make $1 million in the next 20 years, well, that sucks. But if you're only going to make $1 million in the next 20 years, then you don't need a $2 million life insurance policy. It's not a freaking lotto ticket. It's only supposed to replace the income that you expect to make. If you have too much life insurance, you're over hedging, and you're probably spending much too much percentage of your money on life insurance. They don't do that anymore. They used to always sell you those whole life policies and things like that. It's not as much of a thing as it used to be. because frankly it doesn't work. Like people realize that. But that's, some people look at it as like a savings account, but it's not a good savings account. A good savings account is doing what I'm talking about here. Like really no-brainer plays that are going to make you 20, 30, 40% in a year. That's an insurance policy. And then we hedge that just in case. But because we have portfolios that make an average of 30, 40%, that we know we're going to make that much money, then we take 10% of it, of the 30, 40, we take we take a big chunk of 10 out of 30, and we use that to hedge to make sure we can't lose. And so if in a good year we make 40, and in a flat year we make 20, and in a bad year we're even, we're going to have a hell of a good average on a long-term basis. And that's what this is all about. And it's not a complicated system. It's just what we do all the time, and we're doing it in all of our portfolios, and all of our portfolios are successful running the system. SAS short-term trade. We did that the other day. That was in the post yesterday, wasn't it? SAS. You guys are lucky I'm so good at figuring out what the hell you're talking about, you partial sentences. Here's SAS. I don't know what SAS did today, but probably recovered a little bit. Oh, not recovered, but the opposite of recovered. Yeah, sit down a little. But yeah, SAS. So we're basically looking for it to be up around $36 in September. But you see, and here's Wells Fargo. Is that fresh today? Is that what Wells Fargo is doing today? No, a little bit down. All right. So it's a hedge, but this way we're hedging our financial bets. We're expecting a bank sell-off. But if there's no bank sell-off, if the other banks, Wells Fargo already have their earnings. They're fine. So, I mean, they were a little disappointing, but not terrible. So all we did was we said, well, look, we're already holding around 47. So we sold 5 Wells Fargo 40 puts to pay for this spread, and then we bought a hedge. That's it. Very simple. But also, it's the same concept. This is not rocket science, okay? It's just thinking about how you want to protect yourself, how you want to make your money. Is that DBA in the OLT? We didn't do it efficiently in the OLT, but I am going to put that out as a trade because it's such a good trade. Overreaction on CROX, I bet it is. All right, well, it is 245, so I'm not going to go look at all CROX right now. But I would probably say that without even looking that it's an overreaction in CROX, if there's any negative reaction. Yikes, 21%. Holy crap, what did they do? Did they kill somebody? Why is CROX plunging 25% to hell? That? Gotta love you guys. Lower than expected results. CROX, blah, blah, blah. 13 cents. Okay, here's where I want to. Missing the consensus of 15 cents. Oh my God, they missed by 2 cents. Quick, dump the company. Oh my God, what are they crazy? Revenue fell 6%. That's not good. To $300 million in comparison to the prior year. Missed estimates of $349. CROX CEO blamed the global retail environment. I agree with that. See, here's the thing. I looked to see if they're bullshitting or not. Wholesale reorder opportunities contributed to our sales shortfall relative to expectation. Despite declining revenue, I'm encouraged by strategic progress enabling us to mitigate the top-line pressure by delivering better than expected gross margin, blah, 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 blah. In other words, they cut like bastards to try to maintain their profitability, and it still didn't work. As a result, the company lowered its forecast to between 245 and Oh, that's way low. Wow. All right, you know what? They deserve it. No. Revenue down to low single digits compared to year-ended. New guidance reflects cautious retail, slower turnaround in China. Yeah, it's all bad stuff. Nope, nothing exciting about that. I would let them fall further. I mean, there's nothing great here. Let's take a 13 cents. Let's go basics. They were supposed to make 15, and I imagine they have a stronger winter quarter, so it can't go by one quarter. Analysts say, wow, that's harsh. Analysts say 21 cents for the year for an $8 stock. I don't pay $8 to make 21 cents, and I don't pay $8 to make 50 cents. Well, okay, it might pay $8 to make 50 cents. 21 cents, no, that's outside the bound. It's 40 times PE. Well, there's nothing there. So the answer is, nope. They were overpriced, and now reality is setting in. I haven't been watching them for a while. I don't know why they had such a horrible year last year. That's really awful. I'm sure they restructured or did something. But that's the thing. If they restructured and took a loss, I want to know what did they sell. Maybe they stopped doing something, closed the division. They may not have the ability to sell the way they used to sell. Again, that's a very bad thing about charts. If you look at a chart doesn't tell you. You know, like you look at Caesars, for example, or look at CROX first. But, so in other words, between here and here, there's a 60-cent charge last year. They restructured or did something. Okay, if they sold off some division to somebody and took some cash and whatever, or closed the losing division, they no longer have the ability to make this money. It's gone. They shut down the factory or did whatever, right? You have to watch your REITs that way too, because sometimes when they need cash, they'll sell off like a valuable income-producing property, and then the REIT goes down, or it stays flat maybe because they realize a big gain from the cash. But then going forward, they're not going to have that kind of money anymore. Or you look at Caesars, I was just saying, because Caesars spins off this and spins off that. You don't even know what the hell the company is anymore. Oh, and Sears. Here's another great example. Sears is selling itself off bit by bit by bit. So the chart, you look at the chart and go, oh, look, they were 42 and now they're 15 and maybe they're a bargain. They're not a bargain because they don't own the stuff anymore. Those stores are gone. They're closed. Okay, they sold off divisions. They sold off Land's End, right? Remember they sold off Land's End to somebody. It's gone. They'll never have the whole Land's End, all the sales and everything. Maybe that's this gap over here. This is Land's End. It's not coming back. It's a new thing. So you can't just look at a chart and have some fantasy that things are going to go back the way they were. And that can't be the basis of you buying something. You've got to understand why. Why did they dip? What changed in the company? What is their current potential moving forward? Just because something was 40 doesn't mean it'll ever be 40 again. And by the same token, just because something is 20. Oh, I'll tell you a big one that's going on now. Last thing, and then we got to go. The banks, especially in Europe, are really screwing around because what they do, all these banks do this, they have their reserves, right, against bad loan loss reserves, and it's up to them. It's completely discretionary. So they look at their loan portfolios and they decide what the loan loss reserves are. Now, these loan loss reserves are billions of dollars. So all they have to do is lower their loan loss reserve by a little bit, like a point, and $1 billion drops to their earnings because they take it out of reserves and realize it as a gain. So that's why you never see these banks hardly ever miss, because they've got so much of they're like insurance companies. They have huge reserves that they can play with. And so if they make too much money, they add to their reserves and don't pay taxes. If they need some money, they take from their reserves and call themselves even though they had a terrible quarter. So there's a lot of that going on in the European banks. You always have to be careful of what they're doing with their loan loss reserve. And the thing where it's bad is because I saw a couple of the European banks have lowered their loan loss reserve requirements, which is insane in this environment. So they're doing it only to manipulate their earnings reports so they don't look so bad. And that's a terrible, down the road, that lowers your expectations for what they can bring in. All right. And how do I feel about Bitcoin? Do I still recommend a digital dollar currency? I like green coin. Green Bank, what's it called? GRNBK, I think. GRN, yeah. GRNBK. RNBK. I've been, gee, damn it, that's not them. What? Hang on, I'll find it. GRN. BF, sorry, GRNBF. What? That's them, Green Bank Capital, GRNBF. They're just not charted on this, which is because they're a bullshit little penny stock, but that's okay. GRNBF. So Green Bank Capital is pushing now. This is a company that owns Greencoin. Greencoin is it's different than the one biodiesel Chris was working on. It's a Greencoin X or something. I don't know. It'll probably say in the description somewhere. Profile. They're in Toronto, and they're a tiny little thing. Anyway, the asset of this company is that they own a substantial amount of these green coins. Doesn't really explain it here. Okay. Point being, the green coins that they have, they're different than all the other cryptocurrencies because they identify the owner. There is a very clear chain, owner to owner, of who had the money and who gave it to who. So they know every single person who touches the coin, they track it. All right? And there's nothing wrong with that because it prevents this kind of bullshit theft and everything else. And not only that, but you know who loves it? Government. And he's already got, I talked to the guy at this place, he's already got a couple of governments in Europe backing what he's doing. And if this thing kicks off, now it's completely speculative, but if this thing kicks off, it could become a very big deal. Because it's, in other words, all cryptocurrencies are based on anonymity. But anonymity is out. Okay, it's not that popular, and it causes things like this bullshit where people can manipulate the markets and do all these other things. This way, you can't lose your money. It's your money. It's identified to you, and the only way it goes from you to someone else is for you to authorize the transfer of that money to someone else. It can't be just taken out of your bank account and used by other people. It's yours. You own it. It says it's yours. Okay, so if somebody steals it from you, it basically is like putting a big sign on saying stolen from so-and-so. That's what's cool about it, okay? So in other words, it's taking a different take on cryptocurrencies. So I'm very interested in these guys, and we did buy some a while ago, and they're still at the same price. They're not going anywhere. I'm expecting to take ages. Could take a month, could take a year, could take 2 years, who knows? But or maybe never. So it's not the kind of thing, it's just a gamble. It's fun, though. So I kind of like, conceptually, it's kind of cool for 14 cents. You get 10,000 shares, it's $140, and who knows, it could become $1, and you get 10,000 bucks. Is that right? That can't be right. 10,000 shares, $1,400. Sorry, $1,400. So it'll be 10,000 shares, $1,400, and if it goes to $1, it'll be 14,000 bucks. I mean, it'll be 10,000 bucks, and it'll be fun. And if not, you're going to lose 1,400 bucks. It's that kind of trade. It's not certainly not something I would say, well, this is your future. But I just like the fact that it's the only cryptocurrency I've heard of so far that is taking the opposite approach. And he claims to have some sort of a patent on the idea. I don't see how he can patent it, but you know what? Amazon patented the one button thing, where the one touch shopping. They patented that. I'm like, it was on the Jetsons. How can you patent something that was on the Jetsons? Right? They pushed a button and the thing came. That was how it worked. So somehow Amazon managed to patent that. So this guy says he's patenting the non-anonymous cryptocurrency. He's patented the concept, and God bless him. If he's got it, I haven't done that kind of due diligence yet, but it just really piques my interest. So of all the cryptocurrencies, the one I like is the anti-cryptocurrency. All right, now we definitely have to call it close. All right, thanks for coming, everybody. It's been good, and we will do it again next week. All right, take care.